Welcome. Today we're covering valuation multiples P/E, EV/EBITDA, and when they mislead. Let's get started. Valuation multiples compress a lot of information into a single number. That's useful for quick comparisons but also dangerous. A multiple without context can be deeply misleading. Understanding when multiples fail is just as important as knowing how to calculate them. Let's explore the limitations of popular metrics. Price to earnings has several pitfalls. Earnings can be cyclical, making PE look artificially low at peaks and high at troughs. One-time charges or gains distort the ratio. Different accounting choices affect comparability. Companies with different growth rates shouldn't be compared on PE alone without adjusting for growth expectations. EV/EBITDA has its own problems. EBITDA excludes depreciation and amortization, but these represent real costs. Capital-intensive businesses look artificially cheap on EV/EBITDA because their heavy capital spending is ignored. Maintenance CapEx is required to keep the business running. Depreciation isn't just an accounting fiction. Multiples actively mislead in certain situations. A turnaround company may have temporarily depressed earnings, making PE sky-high despite improving fundamentals. Cyclical companies look cheap at peak earnings and expensive at trough earnings. Comparing high-growth and mature companies on the same multiple ignores fundamental differences. Better valuation requires more work. Use multiple metrics together rather than relying on any single number. Adjust for growth explicitly using PEG or DCF models. Consider normalized earnings over a cycle rather than just current results. Most importantly, understand the business before plugging numbers into formulas. Multiples mean nothing without context. Tech companies typically trade at higher multiples than utilities. Business quality matters. A company with strong competitive advantages deserves a premium. Balance sheet strength affects risk. Ultimately, future cash generation drives value. Multiples are starting points, not conclusions. Valuation multiples are useful tools but dangerous if used blindly. Every metric has situations where it misleads. Context always determines whether a multiple is meaningful. The best investors use multiples as starting points, then do the deeper work to understand whether a company truly represents good value.